Hello and welcome to Trading 5 Talents. In today's video, I want to go over a strategy that I have been thinking about, and it involves selling TriWeekly iron condors. So let's take a look at how the strategy is set up and how it might work. So just a quick refresher on what iron condors are. It's an options trading strategy in which you sell both a call and a put credit spread that have the exact same expiration. So I have a video that I'll link to that goes more in depth as to what iron condors are and how to get them set up. But I will also show you how I set these particular ones up for this strategy. So when you open up an iron condor, this is a short iron condor, so you're selling this, you're going to be able to get a credit for putting this trade on. And because it involves a call credit spread and a put credit spread, each of those require 2 options. So you're going to have a 4 option strategy, also referred to as a 4-leg option strategy. And so here's how it's set up. The horizontal white line represents the price line. The vertical dashed or vertical dotted line represents the current price of that particular stock. And then you've got these 4 different color markers here. So the 2 red ones represent puts, the 2 green ones represent calls. Anything that's underneath the horizontal white line is going to be a short position. So this is what you're selling. And anything above the price line is going to be the long position, or that's what you're buying. So you can see if we look over at the green section, so on the right-hand side, this is our call credit spread. We are short a call that's closer to the money, which is the vertical dashed line, and then we're long a call that's further away from the money or further out of the money. So that is your call credit spread. So you're going to receive a credit for that. In contrast, if you go over to the put side, on the left-hand side, the 2 red markers, you've got your put credit spread in which you are short a put that's out of the money, but then you're long a put that's further out of the money. You're also going to receive a credit for that. So what the idea of an iron condor is you want your underlying asset, in this case, we're going to be using an ETF. You want your underlying asset to remain and close in between the 2 short strikes. Okay, so that's the narrow gap between the put and the call on the bottom of this particular diagram here. So it has to close between the 2 short strikes. So I mentioned this is a tri-weekly iron condor strategy. So what is a tri-weekly? Well, we're going to be using the SPY, or at least I'm going to be using the SPY in this strategy and in my testing. So it's going to be utilizing 3 iron condors per week. That means I need to have these iron condors expire on Monday, Wednesdays, and Fridays of every week. Therefore, I need to use the SPY. So this ETF, which tracks the S&P 500, has these tri-weekly expirations, as does QQQ, which tracks the NASDAQ. Now, there might be other ones, but I'm not sure what they are. I know the DIA doesn't have tri-weeklies, but if there's another ETF, I suppose you could probably do the same thing. But I'm just using the SPY because it's more liquid. So when am I entering? I'm going to be entering on Fridays for the Monday expiration. I'll be entering on Monday for the Wednesday expiration, and then I'll be entering on Wednesday for the Friday expiration. So 3 iron condor setups, each of them expiring Monday, Wednesday, and Friday. So here is how I am setting up the iron condors each week and how I'm choosing the strike prices. What I'm looking for is a 70% chance of profit on the short strikes, which is approximately a 30 delta or 0.3 delta or a negative 0.3 delta. It doesn't always correlate exactly, but I use Robinhood as my broker, and it has a percent chance of profit when you're selling options. So that's what I'm basing it off of, just a percent chance of profit. So once I sell the option with a 70% chance of profit, I'm going to be buying one that is further out of the money. So I'll buy an option 1 strike out of the money than the short strike. The 1 strike further out of the money than the short strike. And that's going to result with the SPY, it's going to result in a 1 width difference between the strikes on both the call side and the put side. And I'm going to go through an example so I can show you what I mean with this. And when I do that, I'm looking to enter for approximately 70 cents in credit, which, because this is options, it's going to be $70 per iron condor. Therefore, if it's a 70-cent credit and the width is only $1, that means the max loss is going to be $30 or 30 cents per contract. So 70-cent credit, 30-cent max loss. So let me show you what that's going to look like on Robinhood. All right, so here is SPY, and I already have one set up that it's going to expire on Monday. So if I go to trade and trade options, you're going to see on Monday the 26th, because it's the weekend when I'm recording this, I'm not going to be able to set this up for Monday because it would be a 0 DTE by the time it actually executes. So I'm going to need to set it up for the following expiration, which would be Wednesday, 28th. So let's set it up for the 28th, and we'll set up the call side of our Iron Condor. So again, I'm looking for approximately 70% chance of profit. I'm going to choose this one, the 371 call. So I'm going to sell that call, but then I need to buy one that is one strike out of the money, or one strike further out of the money. So that would be the 372 call. All right. Now, if we go to the put side, we want to start with a sell. We're going to sell the put that is approximately 70% chance of profit, which is right here. So I'm going to tap on that, and then I'm going to buy the put that is one strike further out of the money, which would be the one right below it, the 364. And so I have these 4 options selected. If I tap down here, you can see it comes up as an Iron Condor. And it tells me the prices of each of these options, and in total, it gives me a 71-cent credit, which is extremely close to what I am looking for. Remember, we want to enter for approximately a 70-cent credit because the max loss is going to be about 30 cents. And you can see that down here, $71 max profit, $29 max loss. And that's because the width of the strikes is only $1. So if we tap on this up arrow, you can see the profit and loss graph. As long as SPY stays between the short strikes, then I'm going to enter, then I'm going to have the max profit for this Iron Condor. So that's how I'm setting these Iron Condors up. 70% chance on the call side, 70% chance on the put side, resulting in a 70-cent credit for the whole Iron Condor. So I already put one of these trades on Friday for Monday's expiration. So I just want to show you how I set that up. So I'm here at Option Strat. I already have an account, but it's a free account. So with the free account, you can save your trades. So I just go up here to save trades. And this is the Iron Condor that I put on. So this is for September 26th expiration. These are all my strike prices. And of course, it's an Iron Condor. So if we click on this, you can see the profit and loss graph right here. Which should be familiar for an Iron Condor, and then you can see all of my strike prices. Now, when I enter this information into Option Strat, if you click on any of these options right here, you can actually set your cost basis. All right, so here in Robinhood under my notifications regarding SPY, it has the order confirmation for this Iron Condor. So if I just tap on View Order, you can see when I place this order, you can see that I got a credit of 70 cents or $70. And then here we have the long call and the price. Here we have the short call and the price. Here we have the long put and the price. And here we have the short put and the price. So each of these prices are what I entered here in Option Strat. So that allows Option Strat to actually track the trade in a visual way. And so that's what I did here. So what we're seeing here is the profit and loss at expiration. I'm trying to exit at $60 of profit. So that would be right here, this line right here, as I'm going left to right. So what do I need SPY to close at? Of course, it needs to close between 366 and 371. These are my 2 short strikes. So it just needs to stay exactly where it is. But if I want to, okay, so if I move this date here, so this is today. So this is today, and as we get to Monday, so one thing I do want to mention, so let me go back to today. So here's the profit in green, right? This green line. Notice what happens over the weekend. Okay, so here we are on Saturday. Tomorrow is going to be Sunday, which are here. All through Sunday, notice how the green line is increasing. And so when we open up on Monday at market open, which should be right about here, okay? Notice how far this green line came up from where it was at the close of market on Friday, or even today on Saturday. So all of this increased profit, as long as SPY stays in the same place, all of this increased profit, that is a result of theta decay. Now, If you don't know what theta is, then I'll leave a link to the options Greek so you can understand how that works. But that's the beauty of selling options, is that theta, or time decay, is on your side. So we open up on Monday. If SPY stays the same, then we're going to already be around $50 in profit. Okay. But if we go closer and closer, we want to get to this $60 profit line right here. So what time would that be if everything stayed the same? Well, it would be right about here, and you can see the time is 11:39 Monday morning. Now, if SPY moves, up or down, let's say to right about here, so about, what time is that, 1:30, it can move anywhere from 367 all the way to about 369, 370. So we got a little bit more room for SPY to move. So this is what's nice about option strat, is that you can move this expiration line, or this timeline, back and forth, and you can see approximately when your options are going to be at a specific price. And the default is going to be at expiration. Now, I don't plan on holding these until expiration because I need to exit early so I can place the next trade for the following Iron Condor. So setting up an Iron Condor is pretty straightforward, as we just went through, but the real strategy, the crux of the strategy, is going to come down to the trade management. And so what I want to do is, once the expiration nears, I'm going to be exiting at one of two places. I'm either going to exit at 10 cents for a $60 profit. So how is that calculated? Well, we entered for a 70-cent credit. We're going to buy it back for 10 cents. Therefore, we're going to net 60 cents per contract, which is $60 in profit. So that's my first exit, ideal exit. However, if the trade doesn't go my way and SPY moves beyond the short strikes, then I'm going to be exiting for 90 cents. And that's going to result in a $20 loss. So I enter for a 70-cent credit, but now I have to buy it back for 90 cents. That means I lost $20 on this particular Iron Condor. So the goal of this strategy is to profit from the risk to reward ratio. So I am risking $20 and my reward would be $60. So that's a 1 to 3 risk to reward ratio, which is pretty good in trading. Again, that's the idea of this whole strategy. This is what it hinges on, is this particular risk to reward ratio. With all that said, I would only need to be, right 1 out of 4 times to break even. And by right, I mean getting the $60 profit. Wrong would be having the $20 loss. I would only need to be right 1 out of 4 times to break even. So how do I calculate that? Well, it's like this. If I'm wrong 4 times in a row, okay, $20, $20, $20, $20 loss, I would have a negative $80 in loss, all right? Losing $20 each time, 4 times in a row. But what if I lost 3 times and then I won 1 time? So it'd be negative 20, negative 40, negative 60, then positive 60. So I would break even if I'm only right 1 out of every 4 times. Now, what if I'm right half of the time, 50% of the time? So it's negative 20, negative 40, and then plus 60, which is now positive 20, plus another 60, which is $80 in profit. And that's only being right half of the time. Now, what if I am right 3 times out of 4? Well, it's negative 20 plus 60, which is $40, plus another 60, which is $100, plus another 60, which is $160. This is being right 75% of the time. Now, of course, if you're right 4 times out of 4, that's $240 in profit. So with this strategy, it looks really good on paper because you only have to be right 25% of the time to just break even. Anything above that, you're in profit. But the way that it's being set up is that the chance of profit is 70%. So my chance of profit on the call side and on the put side are both 70%. Therefore, theoretically, I'm setting myself up for a very profitable strategy based on this risk to reward ratio. And the reason I chose the TriWeeklies is because you can see these results much faster than if you were just to do weekly options. Now, I'm going to be reporting back to see how this works in the first week. As you saw, I already set one up on Friday for Monday's expiration. And we'll see if that one works. If it doesn't, then Hopefully the only loss is going to be $20, and then I'll set another one up for Wednesday, and then hopefully that one will be a winner. So if you have any questions about this strategy, about iron condors, or about any of the math that I'm doing here, then go ahead and leave a comment down below or catch me on Twitter at Trading5Talents. In the meantime, if you want to follow along with this strategy to see how it works week after week, then go ahead and click on the subscribe button and turn on the notifications so you can catch each of those updates. Until next time, trade wisely and take care.